All right, everybody. Obviously, it's my fault we were late. I went an extra 2 or 3 minutes on Amit's channel. We were talking about a few things. Before we get started, please take a moment, pause the video, read the disclaimer. We are not financial advisors. We have no idea what your situation is. Please do your own due diligence. We're just two guys that do a lot of research, and our opinions tend to be very strong. So once again, do your own due diligence. Kris, what's
That
going
means
on?
if you're gonna sue anyone, sue Steven because he's got the money. So,
Don't do that.
And just to let y'all know, Steven is a resident of New York, which is a lot more favorable to plaintiffs than it is to defendants. So just letting you know, if you're gonna accuse anyone, accuse him. I'm in Georgia. Thank you, Republicans. We don't, you could try to sue us, but it ain't gonna work out very well for you. So just letting you know, if you're gonna sue, Fiorello's the guy.
Yeah, no, it's not going to end well. Anyway, Adobe, SaaS, CRM, a lot of things going down, Kris. A lot of things.
Yeah. Unfortunately, I think
OpenClaw.
I mean, a lot of the current drawdown feels very similar to the DeepSeek kind of like situation that we had last year, where DeepSeek came out and basically, open sourced this crazy model that had very similar performances to what was current with the AI models, and they were able to do it at a very, very efficient, in a very efficient way. So people said, "Oh my God, everyone's going to switch to DeepSeek and it's going to destroy NVIDIA," and that didn't happen. And we're sort of seeing that with Claude Bot now, where everyone thinks you could just type in, "Hey, Claude Bot, build me a CRM," right? And all of a sudden now Claude Bot can build a CRM and disrupt Salesforce. Or, "Hey, Claude Bot, code me a what is it called? A ticket managing system like ServiceNow." So on face, that is the argument. But if you look a little bit deeper, there's more to it, where even if Claudebot and all of these AI agents could theoretically help accelerate software development, it could theoretically accelerate the creation of a competitor in the future, right? So as an example, you're not going to ask Claudebot to create a CRM for you, but you can say, "Hey, can you help me, code this specific tool?" And, it makes a engineer who's really good a 10x engineer. And actually, depending on the level of sophistication that they have in their prompting and their understanding of like the back end and the technicals, they could theoretically, with a much easier time. Can you move me to the other screen? It looks weird when I'm looking at this way. And there you go. Yeah. So I think when I look at this, I think the barrier to entry for SaaS is sort of getting shrunk by the day. And a lot of these AI agents are the reason why. I do, however, have some strong opinions because I am a user of a lot of these applications that quote unquote are getting disrupted. People think that majority of the value comes in software comes from, going from 0 to 90, and then the last 10% only gets you about 10% of the value, right? That's what you would think. Like if I'm going to go from 0 to 100, going from 0 to 90 is going to give you 90% of the value, and the last 10% is going to give you 10% of the value. It's very linear. People think like that. But to be honest with you, I think a little bit on the opposite side, where I think 0 to 90 is only 10% of the effort. The other 10% is actually the most important. That's where 90% of value is actually generated. And so a lot of these incumbents right now that are out there, they may end up having competitors come out, but it's that last 10% that most of the value is derived from. So someone like you who works in a regulated industry, the last thing you're going to say is like, "Yeah, I'm going to go ahead and switch out my entire organization for that, for new software that may or may not work right in the future." Over 10 years, you've built up a rapport with the current vendor that you have. You've developed all sorts of mechanisms. Your teams know exactly what they're doing in the current software environment that they have. So the last thing you really are going to look at is, "Hey, I'm going to try to save a few dollars and switch out my entire organization's like SaaS." Now, I do think that there's a possibility where future growth can be impacted because software companies have been notorious because they know they have vendor lock-in, that they've been a little bit egregious when it comes to their price increases over time, right? If they know that you've cornered the market and you've got a vast majority of the market, every year they can just keep raising the cost. Like, like look at Microsoft right now with their 360 product. It's like every year it's like, oh, we're just going to charge more, and then we're going to charge more, and then we're going to charge more. And it's like slow cooking the frog until you realize like your goddamn fees are starting to bite into my profitability. So if an alternative comes along, I'm more likely to go for it now than ever before, because you've constantly kept raising your prices and you've raised them a little too much. And I think companies like Adobe are kind of like facing that challenge right now, where people love the product. I rarely hear about complaints about Adobe. I'm sure that there are complaints, but Adobe has some of the best software out there, but people are getting fed up with the price. And just the way that Adobe constantly like nickel and dimes you, it's a problem. So I think this is where in the future Adobe might have to reconsider just how much more they're going to be able to charge. Now, what does that mean for shareholders? That means that, hey, those 20% year over year growth rates that you saw, with 10% coming from organic new customers, another 10 coming in from price hikes, it probably might not work out well for you. So maybe you'll add 5% more people and only be able to raise your prices by maybe mid single digits or even low single digits. That's going to impact your future growth and profit, growth. So this is where we are, right? So I think people are thinking that SaaS as we know it today is going to be disrupted completely. I don't think that's the case. I think if anything, it just materially slows down their future growth prospects. And some of these companies have got to the point where they've been sold to the point where now I would consider them more fair value than undervalued. But I'd like to hear your thoughts on it before I go further.
Yeah, I mean, I agree with everything you said. It's pretty much same thing I've been saying. Being involved in the back end of things, being the one that negotiates the deals and runs the RFPs and helps with implementation, I have a front row seat as to how the decisions get made and how everything gets implemented. And there's only a few opinions that really matter when it comes down to it. The idea that 20% of the workforce is going to be younger individuals in 5 years and they're going to want to use AI or this or that. The reality is enterprise software platforms have a low amount of, I'd say, probability of being disrupted, whereas smaller ones could very easily be disrupted. It's a lot harder when you have and I'm not talking about a 50-person company or a 100-person company. I'm talking about 1,000 to 10,000 and 10,000 plus employees. It's a lot harder to do things differently and get off of your ERP system, such as a Workday, a PeopleSoft, an SAP, get off of a ServiceNow for your backend, for your IT and everything else, get off of your Salesforce for your CRM. It's a lot harder when everything is ingrained into it. And the decision makers are basically staking their careers on if the decision is going to be the wrong decision or not. And right now, when everything is going well and profitability is going well, people are less inclined to take chances. People take those types of chances when things aren't going well. So there's a lot of hype out there. And look, AI is going to do a lot of great things. I sent Kris a model from Claude off of a prompt that I found, and I was super impressed with it. Was the scraping incorrect? Yes, it was. But the 3 tabs, it being able to put everything in the characteristics that it did, and me looking at it as this is the worst it's ever going to be going forward, I'm super impressed with what these things can do. That's a lot different than Johnny in IT and Dan in IT getting together and building some homegrown platform. You're not running something on a Microsoft Access base. You're not building something in one of these AI agentic platforms and moving your CRM there, your ticketing system there, or your HR files there. It's just not happening. And especially cybersecurity. There are things called lawsuits with cyber insurance. There are hacks for target rich environments that house, think about your payroll department. Your payroll department has all your personal information from your social to your bank account number. Companies are not getting rid of their cybersecurity platforms because some new AI product is coming out. All these big companies, and this is the thing most people miss, are implementing AI into their offerings and making their products so much better. So I think it's a lot overblown. I think there's some great deals out there. There's going to be disruption, but I think the really big ones are going to be fine.
Yeah. I mean, the other thing is too, you have to look at it like who are going to be the targets for quote unquote disruption. It's typically going to be companies that have very thin products that, that serve very little purpose to the end user, and they can be easily replaced, right? So if you just have like a scheduling software, listen, you're gonna get replaced. Like, sorry, I don't know how much innovation you can do to get people to use your scheduling software versus someone else's, right? Same thing with like project management software. So companies like Atlassian with Jira, I think they have a problem. I think
Jira, oh my God, I haven't used that in so long.
Yeah, I mean, I'm just saying, like, I don't know if Jira is going to get disrupted, but I wouldn't say Atlassian's the greatest place to be. On the other hand, if you were telling me something like Adobe's a lot more, it's a bigger beast to try to tackle, and it's an industry standard, which is even worse.
I want to address one thing real quick. So I don't text. I'm not sure if you're talking to Kris and myself or not with this comment. You don't need that stuff. The AI agents can do it all. So I'm just going to say, if you are talking about what I was saying, because it came out when I was speaking, AI agents cannot run your payroll. AI agents cannot do your HR and your finance and all that stuff on the enterprise level. Like they just can't. So it's going to be a while, and these companies are going to continue to innovate. But Kris, you got to check this out. I just had Claude run. This is going to be wild what happens in 6 months from now. I asked it to complete a 3-statement model for Amazon, provide income statement, revenue, cost, EBITDA, net income, blah, blah, blah. I asked it for all these things. This is what it freaking spit out. Gives me all the assumptions, gives me the full income statements going back and forward, cash flow, balance sheet, the debt schedule. Now, I haven't checked to see if this is all correct or not, but the fact that it can do all this, and it took 1.5 minutes for this, I mean, think about how much manpower this would be or how much time it would take to formulate all this freehand and actually do everything. Like in 6 months from now, this is going to be wild how good this is. I'm excited.
We'll see.
I'm excited.
We'll see. We'll see. I mean, look, these AI agents are pretty good in that they can distill a lot of information, but the challenge that I've seen that they run into is that, number one, they put in a lot of assumptions that may or may not be true. And the thing is, things are always changing on a daily, even an hourly basis that could wreck an entire financial model. Unless you have a system where it constantly is changing its inputs according to new information, you got a problem. Right. And then the other thing is there's also an element of human sentiment that comes in that's very hard to quantify. So, maybe there probably is going to be some level of, I don't know. I've tried these AI research agents, and I'm not the biggest fan, because even if you think like a Morgan Stanley analyst, there's no definitive way they can actually do that. Not to mention analysts get shit wrong all the time. So, like if you're basically trying to vibe coach someone who gets shit wrong too, probably not the easiest way to make money on this. For me, I'm basically, I'll be honest, I'm a little bit lost on the current market, only because I don't know whether or not this disruption narrative is burnt out if it's real, how much longer it's going to go on for, or if it's it's actually going to wreck a lot of these business models. So like I said, this is where it really comes down to just research, right? And also watching the numbers. So if you're buying into a company like, let's say, Adobe or CRM or ServiceNow, you give it time, like you give it 6 months, and you see that, hey, wait a second, their revenue growth rates are not slowing down, their margins are staying where they are. That kind of proves that this AI narrative is not necessarily as strong as people think, right? So this is where you're basically gambling. You know what I mean? Like it's a weird situation to say gambling on a SaaS company, because typically SaaS companies are pretty much a sure thing based on their cash flows and everything else. You can actually project out relatively easily, but the current narrative is changing. And so I would say the market, recognizing this uncertainty, is just downgrading some of the multiples that a lot of these companies have been getting historically. And I think some of them got to really oversold levels, but then again, I don't know. I don't know what's oversold at this point, because I don't know what the future holds, and I'm not a fortune teller. So
None of us do. At the
yeah.
same time, does Adobe deserve to trade as a tobacco company? Does Salesforce deserve to trade as a tobacco company? I don't know. I mean, and here's where I'm gonna call bullshit a little bit, because you have a narrative forming in the public markets, but the analysts aren't supporting it. I mean, if we look at Adobe, and I'll bring it up, we look at the number of analysts that are covering this thing. I mean, it may not be the most revenue growth, but 35 analysts for this fiscal year and 35 analysts for next fiscal year and 14 for 2028, that's a fair amount of analysts that still see revenue growth year over year. So it's hard to believe that these are going to get disrupted. And the analysts that are at these huge firms that cover these stocks, when you look at CRM, the number of analysts that are covering this, 52 for this year, 56 for next year, and 36 for the following year. And same thing, high single digit, low double digit revenue growth. They're not indicating that these companies are getting displaced anytime soon. In fact, they're looking at it as they're going to be able to monetize this. So I think we're at complete oversold territory on the quality names that are enterprise level infrastructure.
It's a possibility. I don't know. I'm sort of indifferent right now, only because the narrative is so strong. I wonder if there's ever going to be a time where we see a uplift in multiples again to the same degree that they were before. I mean, look at this.
That may not happen.
Yeah, and I think that's one of the things is like investors have to keep a real world expectations on this. So if you look at this is let me just hide this total revenue change thing. This is the multiples for Adobe, right? On a forward EV to EBITDA basis. In 2021, the forward multiple was 38. Okay. Now it's gone all the way down to 8.71. So you're looking at a multiple that's actually on a forward basis smaller than Walmart and Costco, which is kind of insane if you think about it. Let me just put it up right here. So,
man, you just want me to go on my damn rant, don't you?
Go for it.
No, when you're done, you brought up Walmart. I got a big rant about them. Go on.
Walmart and Costco.
I
mean, look, the one thing AI is not disrupting is Walmart. Can't replace Walmart with AI. So look at this. Walmart on a forward EV to EBITDA basis used to trade around 10 and 12, right? That has shifted all the way to almost 23 now. And software, which used to have actually, let me just hide Costco for a second. Used to be almost a 35 multiple, is now trading at 8. So from a pure like a business valuation standpoint on a forward basis, Walmart is about 3 times more expensive, a little bit less than 3 times, but 3 times Walmart is 3 times more expensive than Adobe is, which is kind of insane to see. Like a high margin software SaaS business with margins in like the 80s and 90s, getting wrecked by a company that has 2%, 3% net margins, but they have scale. So sorry, go ahead. Go on your rant, Steven. I'm for it. Give Walmart that smoke.
So I got all the smoke for Walmart. How about that? Everybody, and I'm going to preface it with everybody wants to talk about how Walmart's revenue is sticky, Costco's revenue is sticky, and this is why they're getting such a big bid and such a big multiple, because everybody needs to buy groceries, everybody needs to buy durable goods, they got to go there, nobody's not buying groceries. That's the whole thesis as to why they are so durable, so cyclical, whatever people want to say, and why they're catching a bid and trading at these multiples. Because AI can't disrupt them, because we all have to eat, we all need to take showers, et cetera, et cetera. You can buy all that shit on Amazon. And everybody wants to say that you need to compare like companies. You shouldn't compare this company to that company, they're not in the same sector. Well, Amazon just crossed over and generates more revenue on an annualized basis than Walmart. Fact. Next fact. There's not been a single year since 2017 where on a dollar for dollar basis, Amazon's revenue did not grow more than Costco or Walmart. In fact, from 2016 to the trailing 12, Amazon's revenue grew by 580 billion, 427%. The other two, nowhere near it. They expected from 26 through 28, Amazon's expected 293 billion more, whereas Walmart's only 124 billion more. So if their revenue is so sticky that they're getting a bid, why isn't Amazon's revenue so sticky that they're not getting a bid? Every single thing that you can buy at Walmart and Costco, you can get on Amazon. And what Walmart and Costco don't have is AWS and a growing ads platform that's about to cross over 100 billion in annualized revenue. Neither of them have that.
Really?
So you're telling me
100 billion
AWS is sticky?
100 billion in ads revenue? I didn't know that.
Before it did 28 billion.
Wait, really?
Yeah.
Huh. Wow. Okay.
Yeah. So
that's insane.
Yes.
Okay.
Came out of nowhere. So if their revenue is sticky because you have to do all those things, so is Amazon's revenue. It's even stickier because going forward, there has never been a year where Walmart's revenue grew quicker on a year-over-year basis than Amazon's. Only 1 year did Costco's. It was 2022. But going forward, neither Costco or Walmart grow in the double digits, whereas Amazon is expected to grow by an average of 12.1% year over year over the next 3 years. So Walmart's revenue is more sticky than these two, yet they're not getting the bid because people are scared of the CapEx. And I have a rant about that too. We look at the numbers. Walmart and Costco don't have the same margins. 3.26% profit margin and 2.96% profit margin. Amazon's is 10.8%. I mean,
and it's going to go the other direction too. It's going to keep growing primarily because the main drivers of future growth are not going to be its grocery sales and retail sales. It's actually coming from its high margin AWS business. It's coming from high margin ads business. It's coming from high margin third party seller fulfillment business. So, the mix of revenue is also an important factor to consider. And, that's why I think Amazon's very undervalued. Yeah.
Very. And then when we look at Amazon versus those two on a forward earnings basis, Amazon has double the EPS growth over the next 2 years. Double. Yeah. It's trading at freaking 26 times this year's earnings and under 17 times 2028. I mean, the whole thing is stupid.
here's my question to you then. What is the market seeing that we're missing? Or
Exactly.
is this just, hey, listen, this is an opportunity? You think it's algorithms that are selling Amazon rather than rational investors? You think this is an index situation? Because my theory, honestly, it's indexes where people are rotating into the safe index. And what happens is the safe index has constituents that are consumer defensives, like these guys, right? And so what's happening is people are overpaying for something that they feel is defensive, but it's actually overvalued, and they're selling things at the other side, which is, oh, I'm selling high risk tech, where it's tech is not really at risk. So I think a lot of this is just the amount of market participants over time is shrinking, and we're getting into more index investing. I mean, that's the only thesis that I can come up with, where I think people are selling Amazon to buy Walmart. You know what I mean? Like, so I think a lot of this is just, oh, in a recessionary environment, tech underperforms, consumer defensive. Let's all buy consumer defensives, and people are just buying the index funds. And so the more money's rotating into these index funds, believing that they're getting a great deal and they're getting safety, where in actuality they're getting sold under future underperformance. You think that's a possibility?
I think there is a rotation. I think the market is punishing big tech, and Amazon's getting caught up in the big tech trade, even though the majority of their revenue is not from AWS, but it is their largest profit center. And that's why they're getting caught up in this, because of the CapEx allocation. And here's what I have to say to that. Amazon did not build its company on buybacks and dividends. They plowed every last dollar back into the company to build the company. You go back and read all Bezos's letters. Never cared about buybacks. Always was future looking, deploying capital back into the company. We just saw the CEO of AWS come out. We played it on the Mitch channel just before in an interview and say that they are going to be compute constrained for the next couple of years. Every single chip that they put up, they sell. They're not stopping CapEx. Now, for the market to listen to analysts that have never worked at these companies and simply have an opinion of what they should be doing with the capital is bogus, because they've never built a company that does over $100 billion in cash from operations or $100 billion in EBITDA. They can wish for all the buybacks they want. They can wish to stop the CapEx. These companies are forecasting that this is how they have to deploy capital for the future of their revenue and profitability. It's not one company, it's all of them. So
now, you know what, Steven, I'll defend the analyst from one thing. Okay. We like to think these companies are the smartest, greatest companies on the planet. They're never going to overspend on things or whatever. The thing is, as a shareholder, you do have to realize that they are taking a higher amount of risk, right? Now the payoff can be there, right? And based on past history, they've actually been able to prove out that most of the expenses that they've been able to strategically do them at a very good pace. And this is where you kind of have to have some confidence in management's ability to forecast the future, right? So yeah, I mean, as much as I want to say like, oh yeah, just believe in these guys, everything is good, I do have to also contend that this is technology. Technology has a way where if an innovation comes, it wreck your entire projection timeline. Like as an example, right now, I don't know if you saw the news that just came out on like DeepSeek V3. It's supposed to have like 1 trillion parameters, and it's supposed to run inferencing at like a way more efficient way than the current models are. And so I think what it is people, they invest based on what they're seeing today. They may not be investing based on what they see tomorrow. And so sometimes the analysts, they might be picking up on something, or at least from a risk perspective, if you've already committed to 200 billion in AI spending, and then all of a sudden now the demand falls out from under you, because
not all AI spending though. That's the thing.
No, it's yeah, you're right. It's not
a
all
lot
AI
of it's
spending,
logistical network also. There's a lot of things that they have to do. And the more that Amazon deploys to the logistical network, the more pressure it puts on Walmart, Target, and the others because they're going to burn margin to try to keep up. So
The one thing I will say is that even if they were to overbuild, and this is something that Zuckerberg said last time, which is actually makes a lot of sense. They said, look, if we overbuild, look, there's enough demand in the future that we'll have a couple of years where we won't spend nearly as much, in which case we'll just have like a phase of cost rationalization, right? And then eventually what happens is that compute will become valuable, right? So like, let's say right now Amazon overbuilds and now they have a ton of excess capacity because some kind of new technology came along, and all of a sudden now you don't need nearly as much compute. What happens? Well, the thing with compute is that it's naturally just going to go higher and higher. And usually what happens is when the barrier to entry with a lot of this stuff, it's usually a cost issue. You know, when the costs come down, utilization goes up tenfold. So I think a lot of what we're seeing right now is one part of the equation says, hey, listen, in the future, let's say, you know, these newer chips and newer technology that become super efficient, and we go from a compute constrained environment to a compute oversupply environment, and these investments look like they're not like generating the tangible value that these companies originally thought of. All they would do is simultaneously all just cut back on their capex, and all of a sudden now they get back to being, you know, being normal again. It happened in 2021 and 2022. Remember when all of these companies overhired people? What happened? They laid people off, and they didn't hire hire people for the next 2-3 years until the businesses caught up with the demand of all the people that they had, and businesses did well, you know, and we had a nice recovery. So I think if I was a betting man, this is the thing that I would bet on, is that yes, these companies are spending a lot of money today, and they're doing it based on the assumptions that they have today, because that's all you can really do. But even if there is, quote unquote, a bubble, all they really have to do is just not spend as much in the future, and, you know, use more of their cash flows from the future to just buy back shares and, you know, return value to shareholders, or invest in other businesses like Amazon does to you know, grow value for shareholders. So yeah, I mean, to me, I look at this and I'm like, this is sort of a no-brainer, even though I don't like using the word no-brainer, because
it is. I
when
mean,
you say that,
if you're a trader, nobody knows what's going to happen tomorrow. Nobody knows what's going to happen in the future. But an investment in something like Amazon, that's a 5-year play. That's not, oh, we're going to invest in it a quarter from now. It's going to be sky high. Like, nobody knows. People are freaking out because Amazon's going to be negative free cash flow this year. What I'm saying is, for the long term, that doesn't matter, because Amazon has a track record of doing the impossible and growing a huge business because of how they allocate capital. And if we look at the next year or two as phases of deploying capital for the next 5 to 10 years, if Amazon goes to 150, all good. I can buy more shares than I could today. Every 2 weeks when I buy in my 401k, I'm able to buy more of it in my 401k also through passive index funds. Like, I'm not scared of the market going down. I think that this is a huge opportunity, because if you think 3 to 5 years out, how many companies are going to be able to compete with Amazon, Microsoft, and Alphabet, especially after the next 2 to 3 years of deploying CapEx? I got news for everybody. Nobody. It's a zero-sum game at the end of the day, where only a few companies are going to be able to actually compete in these areas.
Here's one of the charts that's worth looking at, and, you know, it kind of proves out a point. So a lot of people on Twitter, they basically said, look, man, I bought Amazon 5 years ago and I've been sitting on little to no returns, right? So let me just put right here, stock price. If you had bought Amazon, let me just single panel access controls. Boom. Okay. So right here, if you bought Amazon around here, around, let's say, $185, and, you know, from 2020, it traded at, you know, 180 to, you know, about 160. So it rotated around here, right? So if you had bought here, you're looking at this and saying, oh my God, I underperformed the market now because it's all the way at 198. So basically, if you bought at the top at 178, you made like $20 over the last 5 years. So people are really mad. They're like complaining about it. Like, you know, I could have just bought something else and done better, blah, blah, blah. I get you. But the thing is, you bought literally at the top of the valuation funnel. You know, Amazon on a forward basis at the time was trading at about 25 EV to EBITDA. So your enterprise value was really high, you know? So what did you think was going to happen, unfortunately? You know, this is one of those challenges. If you buy a company at a very expensive multiple, that means that the company is in a position where the chances of it underperforming for the next few years are relatively high. Now, what happened in 2022 is that the stock price cratered from about 183 and came all the way down to what was it, like $85. So the multiple actually crashed down to about 9. Okay. That was the low point of 2022 when everything was just, oh my God, the world is on fire. At that point, Amazon actually became very cheap. Okay. $80. Since then, Amazon has rallied from $80 all the way to almost like $240, and now with this recent drawdown to $198. But their business has actually improved significantly, and now is trading at the same valuation or pretty close to the same valuation as it was trading in 2023 at the lows. So right now, you're actually getting a bigger discount than you think on a business valuation perspective for Amazon, even though it's almost $200 a share. So this is where you have to look at this and say to yourself, okay, over the next 5 years, what is this company going to do? Let's say it just keeps its EV to EBITDA flat like it has been since 2023. It stays between 12 and, I don't know, like 15, right? 15 at the max. Let's say it stays at like 12.5. If you look at the EBITDA that this company is projected to generate, going forwards basis, and we'll just go to let's see, annual. Let me get rid of this thing. So if you look at the analyst projected EBITDA that's going to be generated by this company, oh, this is Adobe. What am I looking at? Adobe. I'm looking at Amazon. Amazon, right now it generates 145 billion in EBITDA, right? By the end of 2028, it is going to be double that, about $300 billion in EBITDA. Okay, so let's use that original valuation multiple, right? So let's say we're looking at about a 12%. I mean, not 12, sorry, a 12.5% multiple, which I think is healthy for a company of this size and scale and growth, right? And you multiply that by $319.581 billion, you get a market cap of $4 billion. $4 billion, just, you know, $4 billion. Amazon is not necessarily, has really never really bought back a lot of shares, okay? And if anything, they do use share-based compensation, and their growth rate on their share count is about 1% per year. So it's about, right now it's about, 10.7 billion shares outstanding. So by that time, it's probably going to be around 11. It could be a little bit more, it could be a little less, probably 11. So you divide this by now 11 billion shares, right? So that's like $11,000. Yeah. This company should be worth by 2028 $363 a share. Okay, just based on a 12.5 multiple, which, by the way, in my opinion, is actually, a base case, right? Makes sense. So $363 by the end of 2028. Right now, it's trading at $200. That means you're looking at about an upside of about 75% from here. In a very safe company like Amazon, I'm not seeing anything that could knock these guys down other than valuations compressing even more. And let's say right now, let's say they stay at a 10 multiple. They say, oh, screw it. You know what? We never want to give this company a higher multiple than 12.5, which, by the way, in my opinion, is conservative. They should probably get about 15. You're looking at about, what is it? What did I say? It was 318 billion, right? Multiply that by 10. You're looking at a $318 billion market cap. Divide this by 1,100. or 11,000 shares, you're still looking at $289 a share in the next 3 years. And that's with a very conservative outlook. This is without any sort of curtailment of future share repurchases, which Amazon traditionally has not been doing. So I don't like to include that into my calculation. They have done share buybacks in the past, but only very, very rarely. So let me just show you guys. They typically like to take all of their free cash flow and deploy that right back into the business. So let's just look at share repurchases, net issuances. The only time they ever did a share repurchase was in 2022. They bought back $6 billion in shares. Other than that, never. Actually, they've done it a couple of times in 2012, but it wasn't a very meaningful amount. So the question then becomes, will they buy back their own shares in 2027, 2028 if, let's say, their EBITDA grows faster than all their CapEx? I don't know. We'll see.
Maybe. I think the most likely scenario when the CapEx ends is they do buybacks. I don't think they're going to do a dividend program, but I think that they will buy back shares.
Out of 10, if the multiple is like 8 or 10, hell yeah, that makes a lot of sense to do a share buyback.
Yeah.
I mean, look, the last time they did do share buybacks, it was around that time, right, where your multiple is trading at a significant discount. So let me just layer on. Yeah. That's when they did their share buybacks, when their multiple was extremely low. So, I mean, if that's any indication for you guys, then...
And think about this.
Right. Yeah.
The younger generation, everybody wants to say that Walmart and Costco has sticky revenue because everybody needs to eat and buy groceries and do this and that. Is the younger generation going to Walmart and Costco, or are they going to order from Amazon? All they do is live their life on their phones. And when I say younger generation, I'm talking about people that are 15. When they actually start buying their own stuff instead of living at their parents' house, they're not going to or most of them are probably not going to their store. Most of them can't be without their phone, and they do everything that they order on their phone. And then you look at the even younger generation, 8 to 12. I just think Amazon is something you can hold for 30 years at this point. It's going to get so much bigger.
I do feel like they could unlock some shareholder value in the future by spinning off some of their divisions, but I don't know. I don't think they've ever really done that.
I don't think they're going to. I mean, the whole thing works as a flywheel, and you think about the advertising platform. This is becoming a huge business that came out of left field, and it's sitting right on top of the best two things: Prime and the whole e-commerce division.
Yeah. Which has traditionally been their money loser. But it also supports the ad spending also, because now you've got this entire pool of buyers that are glued to their Amazon order screens, so one part of the business monetizes the other, I suppose,
Yeah, it's pretty crazy. I want to find a couple of stats. Hold on.
It's funny. I did not expect this, but Apple is
a great quarter.
Apple is not spending much on CapEx.
No,
they're being very smart in that they're just like, we don't care. Like, we're not under any threat. Like, our ecosystem is not under threat right now, so we don't care. Like everyone else, in my opinion, I think they're all being forced to spend on the CapEx because they're like, number one, Amazon definitely has to spend because AWS is their highest margin business. And so if they don't spend and they lose the AI market, that means that Amazon and GCP will eventually eat AWS alive, because what happens is, okay, imagine right now you're a developer. You build an app and you build it on GCP, right? What ends up happening now is that all your storage, all your user data, all your processing, all that stuff happens on GCP. that means that there's less work for AWS. So AWS is taking a very like Switzerland approach and saying, we'll host all your models. We've got you on Amazon Bedrock, develop all your applications here. And so even if the AI part of the mix is not necessarily as profitable as, let's say, S3 or EC2, because that's where Amazon makes a crap ton of money. It's a really high margin business. I think that's the ultimate goal. Azure is in the same thing, because how many more people can you get people to subscribe to like Office 360 and Windows anymore? I mean, I'm pretty sure that there's like market saturation, right? So they have to, like, in order to maintain their growth, they have to spend on this stuff. Google, any day now, their search monopoly is coming to an end, or at least that's the market narrative. So they have to create different business lines which grow their top line. I mean, they're doing everything they can with the other businesses like Waymo and GCP and YouTube that kind of make up for that shortfall in future search, search going down, which is their highest margin business. So yeah, Google has to. On the other hand, Apple just says, yeah, we own the ecosystem. We've got what, like 2 billion phones out there?
2 billion install base of devices. So
yeah,
they don't have to, because I'm not as good as the Android devices are. I'm not getting rid of my iPhone. It's just, I'm not doing it. They know that. So they'd rather partner with somebody and pay the VIG on an annualized basis, because in the long run, these other companies have to build it. For Apple, it's going to be cheaper just to play off of one of them rather than build it themselves.
They got me, bro. Apple got me. My entire ecosystem. I have an Apple Watch. I've got an iPad. I've got a MacBook Pro, which I love, by the way. I've never had a better laptop than a damn MacBook. I don't know anyone else in the chat what you guys think, but dude, I have a M1 MacBook Pro, still my daily driver. I love that laptop. Such an easy thing. Every single Windows laptop that I've ever had, after about 2 years, feels like a clunky piece of garbage that it just overheats all the time. It's just, I don't know. Like, I hate Microsoft like Office, what do you call it? Windows-based, what is it called? Windows-based laptops. They're just not good.
Yeah, the only thing I don't use of Apple is their actual computers. Listen to these stats though on Amazon. For Rufus, its shopping assistant was used by 300 million customers and contributed 12 billion in incremental annualized sales in 25. Amazon said Amazon Haul expanded to 1 million items under $10. On delivery, Amazon delivered its fastest speeds ever for Prime members, 70% more items same day than the prior year. Nearly 100 million customers use same day delivery. 100 million freaking customers same day. Right there, Walmart can't mess with that. They just can't. And
Amazon's targeting them now, right? Like Amazon is going to build a super center, like Amazon Super Center.
Check this out.
Chicago, yeah.
Same day grocery delivery expanded to 2,300 cities and towns, while same day pharmacy expanded to over 3,000 towns. It's the best logistical network behind the DoD. And then you start talking about advertising. I gave you a wrong number. It was 21.3 billion, not 28 billion in Q4. So they're getting to roughly 100 billion run rate. And for AWS, as you said, 24% growth in Q4. It's incredible what's happening now. So the Trianium 2, 1.4 million chips deployed. Bedrock is used by 100,000 companies and offers 20 plus fully managed models. it's just absolutely incredible. I don't know how this company is not being valued at the same level as Walmart and Costco. I think it's better than Walmart and Costco, and it's one of the most undervalued companies when I look at things on a forward basis.
Yeah. Yep. The one thing you gotta love about Amazon is that, man, they try. They do everything in their power to try to make industries work. The one thing they really have to do a better job on is this damn Alexa. Alexa's dumb as a box of rocks, man. I mean, I still talk to her, and
I don't even know if it's even in their mind at this point.
I like Alexa. I use it. Ask it weather, ask what, like, it's just, I feel like Alexa could be smarter. That's why. Like, I see the possibility of Alexa.
I mean, you would think with all their damn data centers and everything, it would be, right?
Right. Exactly. Exactly. Yeah, I don't know. What's your opinion on Alexa, guys? I heard Google Home is way better, but I have so many Alexa devices. I don't want to switch. Spy boxes. I don't do anything illegal, so it's fine. They can spy on me all day. I ain't Epstein. Yeah. Alexa is so dumb. Yeah, she is pretty dumb. There's so many times I'll ask her something and she'll give me like something way dumber. Like I try using it for like financial stuff. So like I'll wake up in the morning and be like, Alexa, where's the stock price of Nvidia? And it'll tell me like Nvidia's blah 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 closed.
How excited are you for Nvidia earnings?
Actually, to be honest with you, I'm a little bit nervous.
I'm not nervous at all.
I'm nervous. Gemini is smarter. Yeah, I think Gemini is smarter. I think Amazon needs to just contract with Google and just integrate AI there. I have someone said Alexa Plus. I have Alexa Plus. I feel it got dumber. Alexa Plus made my Alexa dumber. Does that sound even like it shouldn't even be possible? You'd think that it would actually become smarter. Actually became dumber.
Beep, beep. Hong Kong. Oh, yeah. But seriously, that does sound like a paradox worthy of a sci-fi.
You heard that? You heard?
Upgrading to become less capable.
Shut up, Alexa. You're dumb as a box of rocks. Don't talk to me anymore. Sit there quietly. I didn't ask your opinion.
I'm more like a box of glitchy circuits.
Alexa, stop. I'm going to unplug you.
Oh, boy.
I mean, the thing is, I primarily use her to turn lights off and turn lights on, which is like the best function ever. I wake up in the morning, I'm like, hey, can you turn the lights on? Hey, can you do this? Can you do that? Kris will be sent to the AI gulag.
That is definitely an underrated feature, being able to automate everything without a question. There is something about automation.
Wait, do you still turn off your lights like a caveman?
Yes.
What's wrong with you?
I have a light switch right there, Kris.
I know. I'm looking at it. I'm like, what is wrong with you? Why do you do that?
Because
I'm a caveman? Goddamn barbarian? Next time I'm in New York.
Put into the ceiling, but I mean, I don't have it on an automatic control for my phone.
I can control all my lights in my office using that. Alexa, turn my table light red. There you go. See? Alexa, turn my office light red.
The office light seems offline.
It is off.
Sure it's online and has power.
All right. That one's a fail. But look, it did do the lamp, right?
It did.
Yeah. Alexa, turn table light white. There's like a smart bulb in there, so it does it. There you go. Yeah.
Yeah. I mean, yes, very cool. I am not up to 2026 yet. At some point, I will get there. But once again, I think the bigger companies are going to get bigger. I am not scared of them spending, and I am okay if they go down for the next year or two. Am I going to like if they go down? No.
Wait, seriously, Steven, next time I'm in New York, let me help you set this up, man. You're a streamer now. This is actually one of those automations that's really valuable, man. Like right now, like watch this. Alexa, turn off all the lights in the office. And then I just go to, do my thing. Alexa, activate studio mode. See? Right? Right?
So high tech. Man, they should get you on a commercial for Alexa.
Nah, man, she's too dumb. I don't believe in her anymore.
They should get you on a commercial. Now, are there opportunities? Yes, there's opportunities. Are there things that are overvalued? Absolutely. Are there companies that are going to get displaced? Absolutely. It always happens. I have a hard time believing that these companies, if this was just Amazon going off the rails, that's one thing.
My bad to everyone who's got A units at home, because the thing is, like, she's so dumb, she doesn't recognize the person's voice. So when I said Alexa blah blah blah, it turned off all of our users. It turned their shit off too.
Oh god.
Hilarious. Okay.
No, Kris is I'm not going to speak for you. You're not short NVIDIA, are you?
No, I'm long NVIDIA. I'm long NVIDIA.
Kris is loaded to the gills on NVIDIA. Same with me.
Yeah. I'm very long on NVIDIA. How could you not be long on a company when every single hyperscaler said, yeah, we're going to spend way more money this year than ever before? And I'm like, okay, where majority of that money, where's it going? It's probably going to go to NVIDIA. And NVIDIA, I do, however, think that I may, especially if it rallies hard on this earnings and we get like a summer rally, I'll probably sell out of it, a good portion of it, and just wait. Only because I feel like if there's any news about cost rationalization in the latter half of next year, we could see a rotation where a lot of these hyperscalers end up going higher and NVIDIA going down, because it's like, oh, look, their growth rate went from 60% to 20%. And I put that out there on the Twitter, and some people really got pissed off. Dude, I feel like you can't argue anything on Twitter without getting like 100 negative responses, even if you try to put out something logically. You know.
Agreed. I haven't decided what I'm doing yet. I think NVIDIA is going to be fine for the next couple of years. I actually think that they're going to become a holding company of tech companies, and they're going to start making a lot more investments the way that they did with CoreWeave. I am excited for them to own part of OpenAI, because at the end of the day, I kind of don't care if they put 100 billion in. Here's why. And I don't even think that's the number being thrown around. I think it's more like 10 or 50, something like that. But even if they were to put 100 billion in, if they grow their revenue by 50% this year, which is less than what the street is expecting, at their profit margins, they'll do over 150 billion of net income. I'd rather them invest in all these different companies.
Steven, the problem that you run into with NVIDIA is that it's all about future growth. If the expectation of future growth is lower than what it is today, then people sell it off. You know how it is, man. It's as much as I want to be a value investor in NVIDIA and say, oh, look, but their profit is their net income is going to be like great. You know, if you have a shrinking revenue model that goes from 100 to 60 to 20, people are going to say, wait a second, I'm not going to pay 30. I'm not going to pay 20. I might even not want to pay a 15 multiple because of the cyclicality of the semiconductor industry, in which case a 12 multiple might make sense. You know what I mean? So I'm just saying, when it comes to NVIDIA, news and sentiment drove it higher. News and sentiment could crater it as well.
It absolutely could. I'm just looking at my model, and I got them at over 50% revenue growth this year and about 35 the following year. I'm not looking to get out until sometime next year. I am looking to get out. I am not planning on holding NVIDIA for 5 to 10 years. I can tell you that much. It's not in the same category as a Microsoft or an Amazon for me, but I do think that this is going to get to 7 trillion, and that's probably where I'm going to get out of it.
Mm-hmm.
I just think that it's got a lot of potential.
That's funny. Someone's like, I'm going to hold it for 1,000 years. Good.
I wish.
Go for it, brother.
I'll tell you, here's the thing. Meta is the one that I'm getting like very excited about. I think Meta is so freaking inexpensive here.
Yeah.
I'm excited for stock.
Someone said, hey, Kris, NVIDIA analysts already project 25 to 36% growth in 2028. This is already expected. I know, man, but that's under the current assumptions, guys. remember, if anything happens
A
in
lot can
between, and you
change.
have, and that's the thing, like you're seeing this thing with DeepSeek, you're seeing this thing with the credit markets. Like right now, let's imagine.
Oh, look, I want to ask you about that. What do you think
Yeah.
about these freaking credit default swaps on these tech companies?
I
Have you
mean,
seen
the
that?
one for Oracle is insane, but at the end of the day, Oracle's spending so much money. Most of their dude, their Oracle is, in my opinion, the biggest credit risk liability in tech because
100%.
they're spending so much more than they're getting right now. Yes, there's future projections that they could get more, but the reason why they're getting sold off right now is because of this open AI singular relationship. When you have most of your future growth and revenue reliant on one company, that is a lot of risk, right? Imagine right now you have one customer, and if anything happens to that customer or that customer can't get future financing, all of a sudden now your entire data center build out, it just like, oh my God, what the hell is going to happen now? You know? So the question
I
is,
hate their numbers. They report on March 10th. It cannot come
yeah,
soon enough.
yeah, that's the problem that you run into with tech, right? Like right now, we're like, oh my God, we're bullish on AI, and I'm bullish on AI. Don't get me wrong, I love AI, but at the same time, if there's any sort of indication that maybe AI growth in the future is not nearly what everyone is projecting, things get re-rated down.
We're going to see what happens. I am in the camp that these companies are going to get bigger, and we'll see.
Yeah, I mean, this is definitely one of those times where, as a prudent risk manager, you got to be in companies like Verizon.
Ooh.
Verizon is, let me tell you, Steven, Verizon saved my ass over the last 30 days. Okay. Because of my call debit spreads on this low beta name, I have been able to make about roughly 250%. And so all my other safe plays that they've kind of like come down a little bit, Verizon's like, nah, I won't let your portfolio go down. I got your back, brother. And that's what it comes down to.
Dividend coming in too.
No. Well, I have stock in my fixed income portfolio with them. I have a bunch of PDI, which has been doing great. I have some Brookfield, which is doing good because inflation, in my opinion, is coming down. So, but I think the key is Verizon moving up, and because it's low beta, you're able to capture way more when it comes to options, right? So options, they're priced based on volatility. Verizon's not very volatile. So this quick jump from 40 to 50, really, that's a big move for Verizon. That's a 20% move in less than a month. So options, they absolutely explode when you do that. So,
you know what else has been doing well that nobody listened to me on? Bristol Myers.
BMY.
Look at that chart.
Bro, you got to get Ken on here one of these days. Give me a break on a Monday and get Ken on here and have him. He's your pharma guy. Has he retired yet? Dude, some of his plays are just insane, man. He does a crazy amount of research.
No, all of his pharma plays are in his freaking tax deferred account. He is not retired yet. Yeah, he's done really well on that stuff. It's just too risky for me. I can't do it.
Too. I've never made money on pharma.
I've never made money on pharma. I can't do it.
Even my Novo Nordisk positions are getting toasted right now. I thought I figured out, GLP-1s, oral medications, and then some shit comes around. I'm telling you, man, I really need to just stay out of pharma. I've made a little bit of money here and there, like strategically buying like a small and then just getting out, but I hate pharma, dude. I don't know why I even buy pharma.
To buy pipelines.
Yeah. Well, that's the other thing too. I think we should be rotating into
Look at Enbridge. Look at Enbridge this year. With that pump right there.
This is where being in non-tech is awesome. Everyone's like, but just buy Robinhood. Okay. Robinhood went from like what, 150 to now 60. It's 50% down.
I'm a little worried about some of the high beta names.
Which ones? Which ones are the most concerning to you?
Robinhood's one of them.
Hmm.
I listen. It's an amazing company. You put it up against IBKR, it's a little concerning. I don't know. It's a little concerning. Cloudflare worries me. Have you seen Cloudflare's market cap?
I have not.
Cloudflare pumped off of earnings. Look at this. So it's back to 195.
Mm-hmm.
And it's got a market cap of 69 billion. This is another one. 2 billion of revenue. Profitability, none. $70 billion company, no profits.
Someone said, look at the regional banks. Yes, look at the regional banks. They have all done well since 2 years ago.
Yeah, the question is, how much more can Truist go up?
Not that much. It's a bank, man. Shit. You
Like,
buy it when it's
Truist
undervalued.
may have topped out.
They're fine. They're just not going to grow like the crazy
Yeah.
value play they were at 27. Like, look, financials in general are a great place to hide out when the yield curve is steepening, right? Because essentially what they're doing is borrowing short, lending long. Right
You're
now,
not
they're
gonna
in
be
the best
happy.
position.
You're not
Now-
going to be happy.
Who? Me?
You're just not going
Why?
to be happy.
Why?
Flagstar's running.
Oh yeah, I know, man. I know that one's.
Flagstar's fucking running.
Don't curse, man. There's people at home watching that have kids.
11% in a month.
I can't believe I just said
18% in
that.
6 months.
Yeah, I mean, you got Jared Kushner behind you. I mean, was it Kushner or who was it?
Mnuchin.
Mnuchin behind you. You're gonna do okay.
And it's still 14% short.
Yeah, because all the exposure to New York City.
Hold on. What's the
real
tangible
estate.
book value on this now?
0.89, I think.
Tangible book value is 1745.
Yeah, so about 0.89.
It's still not even there.
Wow. Yeah,
This-
so
Just
just
can get back to 20.
yeah. The thing is, their tangible book hasn't really grown much, has it?
No, but it's 1745 after they disposed all the assets.
Mm-hmm.
That's interesting. Let's see what the LDR is. Hold on.
Yeah, it was funny. So like that's rich coming from Kris because I have a big potty mouth. So combined, me and Steven are the egregious offenders of using swear words.
They finally have a positive LDR, so they have more deposits on their balance sheet at
Mhm.
66 billion than net loans at 59.7. That's the first time in a while. That's really good.
Yeah.
They cleaned this up.
Yeah.
Uh-huh.
Yeah, I got to look into them more. It's a good play, man.
Yeah, it's still a good play.
Look at Norwegian. Actually, you know what? You know which one actually could be a good tech play? DOCN. Look that up. Digital Ocean.
Well, tech's getting sold off. The futures are down a ton.
Not this one.
DCON?
Mm-hmm. Or is it DOCN? Digital Ocean. DOCN.
DOCN.
Yeah.
Oh, wow.
How bad is-
What is this company?
This is
Never even heard of
a
that.
yeah. So Digital Ocean, one of the things that they do is they're like AWS where they have a VPS, right? So Digital Ocean has like virtual private servers. So these AI agents that we're seeing like Claude Bot and everything else, you could of course install on a Mac Mini and give it access to all sorts of stuff. But if you want, you can also deploy these things on a private server, which a lot of people are doing, and then having it control all your stuff. So people are saying Digital Ocean will be like, yeah, they're a poor man's AWS. But
Did
if you
go
look
all
at,
in this week?
I did not.
Do you think we're
But if
going
you-
back to on-prem?
Maybe, I don't know. But if you look at the numbers these guys are throwing out, bro, their net income is exceptional. Their growth
it's
is
actually not that
accelerating.
expensive.
Yeah, and it's a $5 billion market cap. So it's a 15 PE. It's growing. It's buying back shares at $5 billion market cap.
So they're saying that people aren't going to want to use, or companies aren't going to want to use platforms on the web to put all their information in. So we're going to go back to on-prem to run stuff like OpenClaw. So it's closed environments.
That's not true.
I don't know that that's going to happen.
They'll just, dude, you can do that with AWS. Like, you're talking about, like, okay, right now, my organization, we have AWS, right? You think our data is just flowing everywhere, training all these bots? No, it's all up behind our stuff, man. All of our stuff. We have data sovereignty. AWS provides that.
This is getting ugly. We'll see how much more tech goes down. I did not. This was not on my forecast that we would be down like this after the earnings report that we got.
Yeah.
And the fact that we're even going lower and we're flirting with 6,800, we'll see. I do think we're getting 3 to 4 rate cuts, though.
I mean, I see disinflation happening all over the place. So let's see where the markets are. Futures. Come on, PayPal. Come to daddy.
Oh, I just wrote an article about PayPal. I think it'll be out on Wednesday.
I hope it was good.
Let's just say I think it's very undervalued.
Yeah. Okay, let's see what's going on in the markets. All right. China is up. TLT is up. UNH is slightly down. ASTS is slightly down. Google is
the
down.
NASDAQ futures are down over 200 points.
200?
Yeah.
Is it because of DeepSeek?
I have no idea, but the NASDAQ futures are down 200 points.
200 points over what? Who's leading the charge down right now? Huh. Palantir's down to 0.3. ServiceNow is barely down. Snow is down. Google is... Okay, so let's do the mega caps. Google's down 1%. Tesla's down 1%. Nvidia's down almost 1%. Meta's down 1%. Okay, so it's pretty much the big tech getting sold off. And everyone else is getting the rotation in. So the story this year has been long Dow, short NASDAQ.
Yep. And you got companies like John Deere running.
It's kind of funny because Trump said that too. He's like, oh, the Dow is at 50,000. I'm like, who freaking still says Dow? Like, like who measures based on the Dow?
A lot of people refer to the market being 50,000. Believe it or not.
I don't get that. You usually want to do S&P 500, if anything. You don't. But then again,
QXO?
Yeah, it's been running too, man. Good job on that one.
27 it's at.
Yeah. How much more do you think this thing's going to go? Oh, it could actually go.
Man, I'm going to put my foot in my mouth right now, but
it's a roll up, man. All I see it doing is just buying companies and
so I'm not going to give a time frame. I think it gets to 67 to 74 a share.
How much?
67 to 74 when it's all said and done.
Yeah, but how can you do that? How can you assume that, considering that they're pretty much a roll up, right? They're just rolling up other companies.
Right. The market cap's 19 billion.
Yeah.
I'm assuming that they are going to hit their target of getting to 50 billion in annualized revenue and trade at one-time sales. And I'm putting a 50 billion market cap for future market cap. And at that market cap, it's around 67 to 74, just quick math. Now, I'm not saying it's going to happen this year or next year. I think it's going to take a couple of years for all these acquisitions to happen. But that's been his goal, to get to a 50 billion revenue company. And if he does that, if it trades at one-time sales, I mean,
one company that I felt like I missed out on, that I shouldn't feel missed out on? Comcast. Because I remember talking to you about
Comcast even up?
Yeah.
It went up after the spinoff?
Yeah.
I haven't looked at it. Let's see. Oh, wow. It did jump. Look at that.
Can you believe that shit's up 11% year to date?
Yeah.
I'm telling you, it's safety. Look at the PE on this thing. Look at the PE on this thing. It's 5.86.
You can't be in everything, and that wasn't as easy of a play. That could have went either way.
Nah, man. At a 4 PE? I don't think so. 4 PE is like 4 years. They're bought back the entire company at that point. Yeah, I remember I said let's talk about it.
Yeah, we talked about we talked about it a lot, actually.
I never jumped in. I was like, you know what? Big tech will continue running. I wish I had as much conviction in Comcast as I did with Verizon. Verizon was an easy one.
You know what's starting to get interesting? And this is something I never thought I would invest in.
Cruise lines? Is that what it is?
Some people in the chat are going to be really happy that I am now thinking this is interesting.
I'm not touching Netflix. Not yet.
I said once it gets to 75, I'll start taking a look at it.
Kris, you're geeked, bro, over Comcast. No, the reason why I'm geeked over Comcast is because it's a very, very low beta stock. And so what happens is the options prices on these low beta stocks is cheap. Like you're talking about the risk to reward being like crazy level in your favor. That's why. So you miss an opportunity. A 10% move on Comcast higher also means that you could actually make probably a 50, 60% move on the options side if
Kris,
you actually time it correctly. Yeah.
Do you think Netflix can get back to 120? Not tomorrow, but next year maybe.
I mean, maybe.
The okay. 60, 70% ROI from here.
I know the problem that I see with Netflix is that how much more can it grow? I mean, it's doing crazy levels of share buybacks. I mean, they've stopped doing the buybacks only because they're doing this Warner Brothers acquisition, right?
I mean, the analysts have it at double-digit growth for the next 3 years.
What are you gonna pay for this? Like, what kind of multiple are you gonna do on it?
I mean, based on this year's earnings, it's trading at 24.5 times, 20 times next year's earnings, and 17 times 2028. I mean, that's not expensive at all. A lot of growth on EPS. At some point, this is going to become too cheap to ignore. I did say 75 was where I would get interested. Nobody thought it was going to get there. Maybe this goes to 70 or 65. I don't think it goes lower than that. I think it would be very hard pressed to go lower than the 65 on this stock.
I mean, I don't know. I think it could get cheaper. I'm all about.
Oh, it can definitely get cheaper. But what are the chances it goes back to 50? It goes back to 2024 levels, beginning 2024. I don't think it hits 50.
I look at Netflix and I see YouTube eating eyeball attention, and I'm not so sure how much more it can do at the current valuation that it is. Because if you look at the future growth on Netflix, it's actually going to be shrinking pretty dramatically. So
what if they get Warner Brothers? What happens then?
I don't know. I mean, you'd have to combine everything. You have to check out the price on this thing, you know? I mean, look, I think that let's say the deal goes through with Warner Brothers. Now, all of a sudden, they've got a whole lot of overlap, right? I don't know what's going to happen then.
Well, you kill HBO Max and you throw all the content on the Netflix platform.
Right. Which means
strip out all those costs right away.
Yeah, but then how many users are you going to add? Like, I have Netflix and I have HBO Max. Like, what are you going to do? Make me pay more for my HBO? I mean, make me pay more for my Netflix?
You kill HBO Max and you freaking put a $5.99 or a $7.99 additional for all make another tier for all the additional content.
I don't know. I see way more value in YouTube than I do in some of these other things. So I'm just
I agree. YouTube is where I spend most of my watch, and then Amazon Prime. But Netflix still has a lot of eyeballs. They're the number one streaming service.
I'll be honest, I only use I have HBO Max only because I want to watch what is that thing called? Night of the Seven Kingdoms.
Horrible.
Steven, you're no longer
so
my friend.
bad.
We're done. We're not friends
So
anymore.
bad.
It's so good. What are you talking about?
So bad.
It's
Oh
so
God.
good. Shut
It's
up.
so
Shut
bad.
up. Get out of here. Shut up, dude.
It is so bad.
No, it's not.
Yes,
It's great.
It is.
What is wrong with you? No, man. It's good. I don't know
Dude,
what you're talking
it's
about.
worse than House of the Dragon.
Do you just not just say that, man?
I did just say that.
I've lost respect for you, dude. I've lost respect for you. I'm sorry.
Dude, I've read all the freaking books. George R.R. Martin still to this day has not freaking finished the next book. I'm so angry at him.
Night of the Seven Kingdoms is not bad. It's good.
So bad.
Dude, my wife and me, we teared up a little bit. Like last episode, we were watching it Sunday night. I was like, I cried a little bit. I was like, my wife was tearing up, and I was like, bro, there's not a lot of shows with that kind of raw emotion anymore, bro.
I will tell you this: that new thing where you can type prompts in and make your own movies that they just came out with. When that stuff gets better, I'm redoing the ending of Game of Thrones.
Yes,
I'm redoing the ending of Sopranos, and I'm redoing the ending of Sons of Anarchy. 3 shows that need new endings.
Yes, agree. Like, which one do you think was the worst ending? Game of Thrones for me is probably the worst ending. Like, that was just like, what the hell? You know?
So the reason I'm going to say Sopranos over it is because everybody thought that the cable went out.
Yeah.
Everybody. But Game of Thrones ending was so bad. How do we not get Jon Snow versus freaking what's his name? I want to say Worm. You know who I'm talking about? The bald guy, the Unsullied. What was his name?
Grey Worm.
Grey Worm. Yes. How do we not get that fight? How?
I don't know. I think they ran through the freaking last.
You needed that fight in there,
bro. All I know is the worst episode was the fight between the White Walkers and when they were attacking Winterfell. And these idiots, their first strategy was what? Let's just send all the cavalry with the flaming swords at these guys, and they killed all the Dothraki in like the first 5 seconds. I was like, what the hell? Like, was there no like tactical planning that you guys were thinking? Like, okay, when you use cavalry, you don't just attack with cavalry like that. You actually let them get close. You funnel them in. You let them get into a concentrated position, and then you freaking run cavalry and pile through. I mean, did these guys not watch Lord of the Rings? Like, Lord of the Rings is like beautiful, man. You remember that?
Lord of the Rings is epic. Not beautiful.
Dude,
it's epic.
Dude, I loved Lord of the Rings. Like, I still watch Lord of the Rings. Oh, did you see Rubio's speech? Like
No.
the one where he did at the Munich conference? Bro,
No.
I felt like he was Aragorn, like giving the speech at the gate of Mordor. He was like, "Rise, men of the West." And I was like, yeah, Rubio, we need to get the West back together again, you know.
No, I was very upset at the Game of Thrones ending. I really was. I wasn't happy with it. And man. Sons of Anarchy ending was horrible. I mean, oh yeah, let's just have Jack's freaking. The only good thing about the freaking ending was that Michael Chiklis was freaking driving the freaking semi truck, who was Vic Mackey in The Shield. That was the only good thing because it was an FX show. Other than that, oh yeah, let's just have Jack's freaking driving to a tractor trailer. What are we doing?
Yeah, I was like, there's better ways that could have like ended. Charlie Hunnam's my favorite actor, by the way. Love the guy.
You watch Sons of Anarchy?
Yeah, all seasons.
Dude.
Yeah. Great,
So,
great show.
Such a good show.
I watched the Mayans too. I like Mayans.
Mayans was good. Wasn't
Yeah.
great, but it was good.
Yeah. Yeah.
It was good. I'm a big
Sorry,
fan.
guys. Sorry if we gave away the ending to Sons of Anarchy. My bad. Don't worry, Jax comes back alive next season.
Don't worry, Jax is just all. If you haven't watched Sons of Anarchy, please go watch it. It is one of the greatest shows ever made.
Who's your favorite character from Sons of Anarchy?
That's such a hard question. Everybody wants to go with Jax, and Jax is great. Opie is great.
My favorite is Happy. My favorite's Happy, dude. Happy's the bomb, dude.
Happy's great. There's a lot of good ones.
Tig, yeah.
I mean,
yeah.
Sons of Anarchy is just such a classic show.
Who's your favorite character in Sons of Anarchy? The people who watched in the chat. Let's see. Or you know what? Who's your favorite villain from Sons of Anarchy? Because they were like villains all of them.
That's a good one. That's a good one.
Tig was good too. Yeah. Rip. Let's see. Green Street Hooligans. Yeah, I've seen Green Street Hooligans. That was awesome. That was a good movie.
Dare we say Pope made it so complex?
Yes. Yeah. Pope was the best.
Do we say Pope made it that complex that he could be the best villain?
He was. Pope was definitely the best villain. The Irish was the worst when they kidnapped.
I mean, Galen was okay, but you knew what was going to happen with Galen.
Yeah. Yeah. Kris watched Shogun. I've watched Shogun. I love Shogun. Saw that too. I got Hulu just to watch Shogun. They're making a new season of Shogun, which theoretically should not be possible because I think that's where the story ends, but they're going to do it again. But yeah, did you ever watch Green Street Hooligans?
Yes.
I love that. That was the GSC.
Yeah, I've watched a lot of shit.
Gemma, she's hot. You know, Gemma was the mom from
Married with Children.
Married with Children, yep.
Yeah. Peggy Bundy.
Peggy Bundy.
It's going to be interesting when we can actually prompt our own stuff for TV shows.
I would love that, dude. I would love to see.
Did you see the thing that Amit brought up with Brad Pitt and Tom Cruise fighting each other?
Yeah, I saw that.
Dude, if they can do that now, what are they going to be able to do in a year from now?
I don't know, man. You know what would be really cool to see?
I'm so ready.
Did you see the thing? Did you see the thing with what's his name from Star Wars, where you had what's his name, Anakin talking to Princess Padme, right?
Yeah.
He was like, what are we doing? AI? We need to build more AI data centers. Why? And she's like, to cure cancer, right? And he's like.
I'm so ready. Did you watch Animal Kingdom, Kris?
Animal Kingdom? No, I don't think so. Like on Discovery Channel?
No. If you like Sons of Anarchy, you have Prime, right?
Yeah.
Watch the first episode of Animal Kingdom, please.
Animal Kingdom? Let me see.
Watch it tonight if you can.
Can we show a trailer of it? Let's see.
No, don't show a trailer, but I put Matt on it. Matt finished the entire series.
Animal Kingdom.
It was on TNT.
Oh, 6 seasons.
Dude, it is so good.
Okay.
If you liked Sons, incredible.
Okay. Interesting. I've never seen this.
Oh my God. I've rewatched the series 3 times.
Is that good? Okay.
Yes.
Yeah. What about any other things to watch, chat? Is there any other shows that we didn't talk about that are actually really good?
Yeah, I need something new to watch. The new season of Night Agent comes out this week, so I will be getting a Netflix subscription for the next month.
Just rotating around month to month.
No,
That's what I do.
pay for Netflix when Night Agent or the Recruit comes out, but they canceled the Recruit. Otherwise, it's the one streaming service I can never figure out what to watch, so I just never use it.
They've got Jurassic World coming out this end of this month.
You know what I started watching again? I'm halfway through it. The Unit.
See, this is what I don't get. How do you not like it? The episode that just came out with the what is that thing called? With hold on. Check this out. Look at this. Night of the Seven Kingdoms, the episode with a 9.9 rating.
Yeah.
How do you not like it?
It was boring. It was slow.
I mean, yeah, the like that filler part was definitely
the
boring,
whole
but
flashback. It's like you're going to give us 20 minutes of a freaking flashback? Come on.
I think it sets the tone, man. It really sets
the tone. You watching Industry?
Nah, it's kind of stopped. It
became
more of,
Industry is so much better than freaking Night of the Seven Kingdoms.
I kind of stopped watching because it got pretty much all just Harper trying to bang everyone, and then that dude was getting pegged at one point, and I was like, yeah,
this season's
like,
good.
The guy's like trying to like create the PayPal of banking industry, and I'm kind of got bored by it, and I was like, all right, I'm good.
Somebody said Homeland. I love Homeland. I tried rewatching it. I can't do it. For some reason, the episodes feel so drawn out and long, but Claire Danes is amazing in it.
Begonias. Do you mean Borgias? Is there a Begonia? What is that? Begonias?
I think they spelled it wrong.
I think he meant Borgias. The Borgias was a
good, I think also.
The Borgias was a good TV show too. Did you ever watch that? The Borgias?
I watched the first season. I never finished it.
Okay. I think we went on too many tangents with this like movie and TV show side quest. Yeah. But the point is we gotta at least do a 5-minute talk on Adobe real quick before we go. Because I mean that was what the title that I put on Twitter was anyway. Okay. Adobe. Is it a buy? Is it a hold? Or is it like, hey, wait and see? What do you think?
I'm gonna give you my very 1-minute assessment, then you can go off.
Okay.
I started a position in ServiceNow. I have a position in Salesforce. Adobe's numbers are better than both of them, and it's the one I'm the most scared of. I don't understand that space enough to make an educated guess. I know that a lot of what they do cannot be replicated in AI yet, or maybe anytime soon with editing and all that stuff. I'm worried about the lower end stuff that people pay the 15 or 19 a month for, that they're not going to need to use that because of how good AI free tools are. So, and I don't even know how much of their business that is. I don't know enough about it, but from a numbers perspective, Adobe is incredibly cheap. I'm the most scared of it. I haven't started a position. I just don't know enough.
I mean, I'm getting two tales on it depending on who I talk to. Some people are saying their best days are behind them. They're not really worth it anymore. And then other people are saying that this is an industry standard that they can't live without. And whatever price hikes come, they're willing to absorb them. And then they've also got, like, from an investing standpoint, they're doing massive amount of share buybacks. So whenever you see that, so I mean, you've got tremendous value there, right?
Trading at 11 times this year's earnings.
Yeah.
Like Adobe's the cheapest in the sector from all the ones I pulled, and it looks very undervalued. And when you look at the actual metrics, I mean, look at this. It's trading at almost single digits for EBITDA, operating income, and free cash flow. Great margins. It scares the hell out of me. Should this be a $100 billion company? Probably not. But the question is, do they lose revenue and market share over the next couple of quarters? I can't answer that. I have no idea.
Someone I like what Raven P01 put. If Adobe gets to PayPal's valuation, I'll get in. I'm the same way. I'm thinking the exact same thing. I'm like, if they get to about a 5 forward multiple, like EBITDA, I'm in, baby. At that point, it'd be too freaking cheap to ignore.
Dude,
Because at that point, the value, like PayPal right now is at 16% yield, share
Dude.
buyback yield. So
have you ever seen a company like this? Look at these damn metrics for PayPal. They're trading at less than 6 times EBITDA and 6 times operating income.
those EPS estimates are wrong, right?
No. This is on their current numbers.
Right. No,
They're-
I'm telling you, it's wrong though. It's wrong. They're actually about 15% higher than what's currently.
No, but I'm just saying on the current EBITDA that they've generated in the 2025, this is what they're trading at. I have never seen a company that continuously has always increased revenue and is this profitable trading at these metrics. I've never seen it before across the board. I've never seen it.
Well, the good thing is PayPal doesn't even have any debt. Other companies that trade at multiples like this, they typically are stuck with a crap ton of debt that they have to like pile themselves out to. With PayPal, there's little to no risk of bankruptcy, right? So it's being priced like it's going out of business, but it's not going out of business. And do I think that it's
community has them increasing revenue every year going forward? How do you go out of business when you increase revenue?
your margins take a hit? But once again, you don't have any debt, so you don't have to worry. I mean, look, to be honest with you, right now would be a great time for them.
24,000 employees. You think a RIF's not coming?
Yeah, that's true too. That's
They have
true
24,000 employees. They're going to do a RIF, and when you
reduction
think
in
about
force.
cash
By the
on
way,
balance
everyone,
sheet,
Steve says RIF, but it means reduction in force.
reduction in force. And then think about this: they're going to deploy $6 billion to buybacks. If they just take $5 billion of the cash on the balance sheet and add that to buybacks and do $11 billion this year at a 45 price point, it's 28% of the company.
By the way, someone said, give me a 4% dividend yield on PayPal and I'll buy it. Not worth, like at this price, it's not worth doing a.
I was with you on that.
dividend.
It's 70 a share. At this, buy back the damn shares.
Yeah, buy back the shares. Like right now, the yield on just their dividend yield, because PayPal is now actually paying a dividend too. You're getting about 1.4% dividend yield. And then on top of it, you're getting that 16, 17% buyback. So I think end of year target for me for PayPal is like $60. If it gets to 60, that's a 50% rise.
Dude,
you know, people,
I am in the same camp. I think this goes back 55 to 60 on PayPal.
Yeah. I think the sheer magnitude of the share repurchases will get this thing back to the 60s. That's why I'm trying to tell Roy, I was like, look, man, the opportunity here is just get into those spreads now. This thing will go up and you could sell those spreads and, you know, average your position and recover some of it. I mean, you literally held this thing at $60, $70 at a multiple, like a 12 multiple. Right now, you've got massive amount of share buybacks with like a 7 multiple. This thing, in my opinion, should be trading at a 10 multiple, right? It'll get there.
So somebody just said the buyback yield is 7.35%. They're buying back at the current market cap. Current market cap's $39 billion. They are slated to buy back $6 billion worth of shares. That's 15.38%.
Yeah.
It's $6 billion divided by $39 billion. If
Aaron, I think we might be looking back.
It's about 28%.
But Aaron, I think you're looking backwards, dude. That's why.
Looking backwards.
Yeah. So if you look at like the chart and what happens is they end at December 31 and you look at the buyback yield, it's going to show you 7.3. What you have to do is you have to take today's value and then look at the future share buybacks and see what kind of yield you get from that. So just letting you know, I mean, if you're going to do the calculation, that's how you do it. You don't.
And they may not buy every share back at a 39 billion valuation, but if they took that, what I would do if I was them.
It's 37 billion, by the way. 37 billion. 37.09.
I thought it was 39, yeah. So 37. So it makes it even better. So 6 billion in buybacks is a 16.2% yield. I would do 6 billion of buybacks tomorrow and replenish that cash throughout the year with the free cash flow. Do it now while it's at the price.
Or here's the other option. Well, technically you can't do it this way, but because the market would pick up on it. Do a convertible
Convertible
preferred
to note.
offering.
Yeah.
Yeah, like a 5% convertible note with like maybe a 2030 maturity and a what is that thing called? And a conversion price of probably like maybe 90 or 100. You do that, bro, you get that 5-6 billion in cash, buy it back right now, EPS skyrockets. Sure, you've got some future debt obligations on the balance sheet, but you can afford that with existing cash flows. In which case now, but see, the problem with that, Stephen, is that if they announced that, the shares would go up right away. They don't have
They
thing
have to announce that they're buying back shares. They can just freaking do it and tell everybody on the earnings call what they did.
See, that's the thing. Like, I remember Couch Investor and what's his name and Roy, they were talking about, they're projecting negative year-over-year EPS. I'm looking at him and I'm saying, was that before the company was down 30%?
Right.
Or was that after?
So here's the thing.
Yeah.
There was a 14-cent pump in EPS this year because of the investment portfolio that they're expecting isn't going to be there in 26. But even the 14 cents, I'm with you. I think they can manufacture that from the buybacks and still have EPS.
Yeah. Exactly. Every number I'm running gives me like almost like a $6 EPS target. I'm like, y'all realize that like if you buy back your own shares at like a 30% discount, that's pretty significant value accretion going forward.
I'm with you. I don't understand how it's here. I've been wrong on PayPal. This is not a dead company. They're still expected to grow revenue. They're still expected to grow EPS. And I don't see how the vultures are circling right now. This is not a dead carcass. It's throwing off $6 billion of free cash flow. I'm not saying it's going back to 150 or 200, but $40 is way too inexpensive.
Yeah. I mean, look, I thought fair value was 60. That's why I didn't bother buying into it. So whenever I saw these guys talking about PayPal, I was like, look, their growth rate is slowing down. I view them like a traditional bank at this point because their growth rate is so low and their main source of future growth is actually going to be coming from the buybacks. But at $60, the buyback is like, it's effective. It'll definitely help you grow, but it's not going to help you get to like market beating returns. At $40, you're talking about literally a massive haircut, 30% haircut from the $60 mark. So to me, I think this thing recovers easily to 60 within the next, maybe even not even 1 year. Maybe it recovers to the 60 in a year and a half to 2 years. Tell me where you're going to get a 50% return from there.
No, you're not. And here's the other thing.
Yeah.
Do we really think it's going to, like, for people who are not invested, I'm not talking about people who own it at 60 or 70. For the company it is today, for the share price it is today, what is the probability it goes to 30?
I mean, it's possible, but
I'm not saying it's not possible. I'm saying, what's the probability? You know, like
I don't think there's a lot of probability. The only reason why I don't think it's a lot
talking about down another 25%, you're talking about going to 27 billion market cap, like
not with those share buybacks.
Not with those numbers.
Now, dude, they'd be setting a pretty strong floor with those buybacks. I think this is we're either at the floor or we're close to the floor. Maybe even it gets down lower to maybe like the mid.
And I'm pretty sure that CEO did cuts at Hewlett Packard.
The guy literally ran the same playbook: efficiency. So you'll see.
You're telling me that they can't run that company with 15,000 employees?
I think the strategy here is simple. I think it's a shrink to grow strategy. Have you ever heard of that? You know, where you basically are shrinking down. You may not be growing your top line nearly as much, but you're more effective with your cutting. So what happens is your net income starts to go the other way. And then when you pile that on with cash flows and savings, and then, layer on these buyback, it's great value at $40. Like I said,
it's not that PayPal has no debt. It's that they have more cash on hand than long-term debt, with an additional $4.5 billion in long-term investments. They are net debt positive. So it's not that they don't have debt. They have like $9.8 billion in long-term debt, but they have more than that in cash on hand.
Roy, get back into PayPal, Roy. Come on, man. Headcount looks like 22,000 in 2028.
Yeah, I'm
Roy,
not buying
that
Roy.
is the old CEO, Roy.
Yeah,
I'm telling
the new
you.
CEO is going to cut this down to like 15,000 people. They don't have any stores. They have no consumer-facing anything.
Yeah.
It's about a bunch of account executives and IT people.
Roy, I'm telling you, the guy is gonna come in and he's gonna cut. All right. The guy's name is efficiency. Free cash flow makes buybacks and dividends sustainable, even if EPS contracts as guided. I'm telling you that EPS guide is because you didn't have a 30%. You had a 30% drop, Roy. The share buybacks at a 30% discount are value accretive to EPS growth. If anything, it sets the stage for a resurgence. Dude, the guy came in and the first thing they did was do a kitchen sink quarter. They kitchen sink themselves hard to make their meaning. Dude, they're going to be able to make their numbers going forward. And if they make their numbers, they won't cut that deeply. Okay.
Chris,
that's
you ready for this? This is Verizon all over again.
This is literally Verizon all over.
Literally Verizon all over again, where you and I are the only people that are calling it. Everybody else is against it.
It's because everyone's been scarred by it. Everyone calls it PayPal and all that stuff.
Yeah, we're not scarred by it. We didn't lose money in it.
That's true.
We're looking at it. It is. I always go back to this analogy. You seen the movie Moneyball?
Yeah.
All right. When Billy Beane is talking to David Justice, I'm not paying you for the player you used to be. I'm paying you for the player that you are today. I'm going to buy PayPal for the company it is today, not where it was in 21.
I want to squeeze that. I want to squeeze that last bit of juice out of you. Oh my
God.
Yeah, that's right. I want to squeeze the last bit of juice that's left in PayPal. Hell yeah, I'm all for it.
Who says there's a last bit of juice? None of the analysts are calling the last bit of juice.
No, I'm just saying
this is going to grow.
I think it's going to grow, but I'll like I said, they'll shrink to grow, which is fine by me. I don't mind. I'm a value investor.
Once the share price goes up, I don't care how they grow.
Yeah, I'm for it. And like I said, the options market on this thing, if you know what you're doing, you could get a very, very good return with very little risk. That's all I'll say there.
I mean, this is the reality of PayPal.
You know, I ordered a new case for my Ray-Ban, like Meta glasses, and it was done via PayPal. And I got like all the notifications and everything on PayPal. The one thing I don't think people are taking into account, which actually could save their asses, is ads. Because ads monetizes at a much, much higher pace. It's got a few lines of code. So even if there's any sort of indication of not necessarily let's just say it keeps their revenue growing at a mid-single digits, and you do crazy levels of buybacks that you're doing right now, dude, that's still crazy amount of shareholder value that you're going to be able to get in the future.
So look at this. 39 analysts on the street expect 3% revenue growth. 39 analysts on the street expect almost 5% in 2027, and 17 analysts are expecting almost 5% in 2028. Okay, this may not be an exciting stock, but the consensus on the street from a large cohort is revenue growth every year. That's not a dying company. The narrative is overblown, and the EPS is expected to grow.
So Roy says, problem is they never talk about ads. Either they're idiots, maybe, or things aren't going well there.
They don't even need to do ads. I agree they should.
I think they're so early in their ads journey that it makes no sense to talk about it and get the market expectations higher, especially when you've got this crazy, crazy amount of future growth that's going to be coming in from share buybacks. The last thing you want to do is talk up your own stock and make the future beats harder for yourself. You should be doing everything in your power if you're the new CEO to come in and clear the decks and basically just put all the blame. Yeah, you ever what was the show? There was this thing. You remember? It's called the 3 letters. So every president before they leaves, they give 3 letters to their predecessor.
Yeah, it was in House of Cards that they did that?
I don't remember.
I know exactly what you're talking about. First letter is
blame everything on
me, and then the second letter is start writing 2 letters.
Yes,
it was 2 letters, not 3.
Yeah.
Yes. What movie is that from, or what series? I know exactly what you're talking about. Shit. Oh, you know what? It wasn't the president. It's from Traffic. When he's the chat's right, with the czar of the drug czar. It's freaking Traffic. Great movie, by the way.
Sit down into Nikita Khrushchev. I think
great freaking movie.
When Nikita Khrushchev was forced out as the leader of the Soviet Union, he sat down and wrote 2 letters to his successor, Leonid Brezhnev. He said, when you get yourself in a situation you can't get out of, open the first letter, you'll be safe. When you'll get yourself into another situation you can get out of, open the second letter. Yeah, I think this is blame everything on Alex Kris phase of the equation right now.
100%.
So, which is fine. We'll see what happens. By the way, I am not trying to be in PayPal long term. Okay. If I see PayPal recover nicely to that $60 mark, my ass is selling. And I'm chilling on the side. I don't want to buy PayPal at a fair value. I want to buy it at an undervalue.
Oh, yeah. Right? PayPal is not something that I think is going to 150. I said that about 10 minutes ago. I think that this can go back to 60 to 70. Yeah. And if it goes to 60, like Kris said, that's a 50% ROI from where it is today. So that's why PayPal is looking really interesting here.
I'm telling you, I'm a mercenary, bro. Got to get in while the market is underappreciating these things, and then chill. You know, if I want to perform like the market, I'll buy the S&P 500. I don't need to do all this other shit. But if I want to beat the S&P, got to buy the stuff that's undervalued, and also apply leverage at the right time. So
let's pretend you didn't say that.
What? Apply leverage?
Let's just pretend you didn't say that.
Why? That's what you're supposed to do, no? Like
because
when things are going
too many people use it incorrectly.
Huh. Yeah.
I'm not saying you. I'm just saying too many people use it incorrectly.
Yeah.
Like too many people don't have the cash to back it up if it goes sideways.
Yeah. Someone says, I want to buy Grab stock. What is your target? Guys, Grab is a great company. Long term, it's going to do fine. The challenge that you guys have to remember when it comes to Grab is that their growth is only 20% year over year, and they have 4 billion shares outstanding. 4 billion shares outstanding. Let me repeat that. 4 billion shares outstanding. Stop trying to buy these low like dollar value companies hoping for a 20x. If this company were to go from, let's say, $5 to 100, that would make it the most expensive Southeast Asian like company on the planet. Okay, so just there's 4 billion shares outstanding. They're doing share buybacks. Yes, you are correct, Fetz. They are doing share buybacks.
No, I think we call it, Kris.
I think we call it. Are you buy? So basically, if Adobe goes down to what is it? Goes down to 5, 6, 7 multiple. What do you think? Well, it's actually at 8 multiple forward. So
I don't know.
20% from here. 20%. You think 20% lower?
I don't know about that industry. I don't know. Adobe's something where if it goes back to 500, I'm okay not being in it. It's just something I just know jack shit about. I don't know about it.
I mean, we could do a quick technical
I'm way
analysis.
more. No, it's not about the technicals. The business. I don't use it. I don't do anything on it. I'm just worried that it can get disrupted. I don't. The problem is I don't see Adobe as an enterprise software platform the way I see ServiceNow and CRM.
I mean, it's because the industry you work in
Yeah,
is like that.
and that's
So
why I'm saying I just don't know enough about it.
give me 1 second. I gotta sign in. What else is new with you, man? Are you investing in anything else?
No, the last things I bought was Microsoft and ServiceNow. Actually, I bought more BM&R.
I'll be honest, I'm a little bit regretting not selling UNH like a few weeks ago before
Why?
earnings. Yeah, it's down since then, primarily because that stupid news that came out with the Trump administration and the news around Medicare Advantage. So basically, they want to lower the amount of Medicare Advantage rate increases for 2027, and so that is not gonna be good for them. But as of right now, it's just an estimate. So as an estimate, it's not really that big of a challenge. What the hell?
I'll tell you what I'm going to get really interested in. I shouldn't say because it's a dumb idea. I'm saying interested, not buying. ARC G.
You lost me there, bro.
Listen, I think genomics is going to be huge. I know nothing about the industry. I don't want to know about the industry. I just think that AI is going to have huge medical breakthroughs, and some of those companies are probably going to do good. Like, do we not think that CRISPR is going to do well in the future?
I don't know, bro. After the whole thing with COVID, I'm not sure I'd like that space. I mean, the amount of like negativity towards the genomic space from that may not. Why am I not getting my email, man? What the hell am I waiting on? All right, whatever. Sorry, guys. I'm not going to be able to show you guys anything on the trend thing. I have to log in, and I can't log in. So, yeah.
I gotta get going though. I have to be at a construction site tomorrow morning.
All right. Congratulations. Are you still looking at Sprouts? Yes, I am still looking at Sprouts. I want to see a few more quarters of execution before I really like sink my teeth into it. I think that there's better opportunities right now in oversold tech. So that's where I'm keeping my eye right now, especially SaaS. If the indication is that SaaS is not actually dying and we're actually getting a great discount relative to the value of future earnings, then I don't want to be speculative. I want to just buy a sure thing. And if I want to buy a sure thing at a discount. So right now, I think that's where we're at with a lot of these SaaS names and possibly Adobe. So just keeping my eye on Adobe right now. I do not have a position, but if it does get low enough where the risk to reward is so far out in my favor, then I'll be a buyer.
I hear you.
That's about it. Yeah.
All right. Thank you, everybody, for joining. I got to hit the sheets. Kris, are you and Matt doing Cash Flow Chronicles tomorrow or Thursday? When are you guys doing
Probably.
Okay. Kris and Matt will be doing Cash Flow Chronicles Tuesday or Thursday, or maybe both. Please go follow them. And
Roy, buy PayPal, Roy. Come on, man. Come back to the fold, Roy. Come back home. Roy,
Come back to the
home.
fold.
Come back, Roy. We want you back, Roy. We
They
need
want
you
you
back.
back.
We need you back, Roy. Come on. All right. That's it.
All right, everyone. Have a great night.
Later.